Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Today, very super special guest on this episode, Kathleen Hinman, who is the chief economist and program associate at the GW Investment Institute. Reminder, this is a podcast by the GW Investment Institute, educational entertainment purposes only here at the GW School of Business. Welcome, Kathleen, to this episode of Market News with Rodney Lake. Great to have you here.
Thank you. It's great to be here. Yeah, I am. So yes, as you said, I'm Kathleen Hinman. I'm the program associate and chief economist at the GW Investment Institute.
Excellent. Well, Kathleen, it's a thrill for me to have you on the episode, on the podcast, your first episode doing this, so thank you. For everybody that's watching and listening, number one, thanks for people coming back. This will continue to be, I hope, we'll have to see, I guess, how this episode goes, but the goal is to make this a reoccurring episode. And the title of this report that you're going to provide, an overall report, is the Hinman Economic Report, also known as the HER. And so we're super excited to hear a lot of this stuff. And as investors and business people, analysts, I think it's important for us to be always thinking about, this type of data, what's happening in the market. And we really appreciate this opportunity to connect with you and really get your expertise on this. As a reminder to everybody, Kathleen is an alum. Maybe you can tell everybody which degree you have from GW.
Yes, I received my MS in Applied Economics this past May. So, yeah.
Excellent. Shout out to the economics department. School of Business still number one. What we do love the economics department in the Cumming College. So thanks again for being on here. So let's maybe start diving into some of these things to talk about in the Hinman Economic Report. So I think top of the list that people think about is GDP. Could you maybe talk about where the numbers are and your outlook for growth?
Yeah, so second quarter, GDP was at 3.8% growth. This was quite a difference considering quarter one was negative 0.6%. So it grew a lot, and the finance and insurance group was actually the biggest performer with the most gains. And I think...
Yeah, I mean, where do you think it's going from here? For 2026, so we're to close out 2025, we're recording this in mid-December 2025. For 2026, what do you think the outlook is? Do you think, this type of growth we're going to have again, this 3.8 as an example? Or do you think we're going to retreat back or some other version of that? Again, for 2026 and let's say beyond, what's the outlook for the Hinman Economic Report?
Well, I think third quarter and fourth quarter will probably continue to increase this year. However, 2026, I think it will probably be more of a stagnant growth, of 2% or something like
that.
And
what drives the thesis for the slowdown?
Well, I'm not really sure. I think, yeah.
Yeah. No, well, look, I think it's fair. A lot of people have been predicting a recession for quite a long time. And I don't know if that's recession territory, but certainly a slowdown in the economy. And so we'll have to see how that plays out. So let's move on to some other categories here. And so consumer spending, the PCE, as a lot of people use, and obviously right now people are super focused on inflation. Any thoughts around consumer spending and what's happening with respect to that? Many people talk about, well, the consumer has held up super well and has been doing way better than people expected. What are your views there?
I think people are going to continue spending, honestly.
In the U.S., probably,
yes,
right?
In the U.S. So in September, it increased $65.1 billion. It was a 0.3% increase from month to month. Unfortunately, with the government shutdown, the October release date is being rescheduled. But I honestly think people are still spending. I think it's going to continue to grow. So, yeah.
Yeah. I mean, it's been difficult to bet against the American consumer. People like spending. People want to spend, and we're going into the holiday shopping season, and it seems like people will continue to spend here. People keep talking about this bifurcated economy. I think we'll have to keep an eye on that. That the luxury spenders are continue to spend, but maybe not as much on the middle and lower income side. Let's move on though. So one of the things that came out today actually is unemployment. So you got data again today. It's mid December here, but we can give the date 12/16/2025. And you had unemployment data come out today, and it ticked up slightly. It was 4.4. Now it's 4.6. What is your view there? Do you think that this is a really meaningful difference? Do you think unemployment is a concern at all?
Well, I think it's interesting because the unemployment rate changed 0.2%. However, the total non-farm payroll employment actually stayed pretty similar.
Okay.
And so that's like the employer report, whereas the household survey is the unemployment report.
Okay.
And
that's an important distinction.
Yeah, and they did actually say that more people reported this year, this time than previously. So that could also be affecting the unemployment rate. So yeah, we'll see. Hopefully things continue to be going well. I mean, I think definitely a lot of times the Federal Reserve will look at the unemployment rate for their rate decisions. And I think that they'll just continue to wait. I don't think this was so drastic or anything that it's going to be a big deal.
So you don't think this will drive any difference in the outcomes for as far as when the Fed and how much they'll change interest rate target?
Right, exactly. I think they'll probably wait.
Yeah. So I think it sounds like what you're saying, and you can let me know if I've heard it correctly, that given that, this is a modest uptick in unemployment, it's probably not likely to impact the rate of change or the change at all from the target rate. And really, this seems kind of maybe mildly supportive of lower interest rates, but certainly not something where they're going to make a make or break decision on. Would that be an accurate description of what you mentioned?
Yeah, that's exactly what I was thinking. So yeah, I do know though people are saying it's the highest level in 4 years. So people are concerned about that, but
yeah,
it's still below 5%. So,
yeah, right. Historically, it's a good point. Historically, it's still a low number, relative to other times in history. And so I think this, a lot of people want to read into this data and are looking for insights, but it's very challenging when you're at less than 5% to really say much about it other than, well, we're at or near full unemployment. And obviously the rate of change is super important. So it's ticked up a little bit. And so we got to keep an eye on that. Next up here, I think, inflation. So that's been an ongoing topic. Lots of people are concerned about higher prices. Certainly at the pump, they're going lower. And so you see oil has moved down significantly, almost 15% year over year. But other goods, if you're going to the grocery store, is always the common example that people use on the news. Everybody's paying more. Any views on CPI, and then how should we be thinking about inflation?
Well, I think you're correct that oil's going down. I think it's going to continue going down. Mm-hmm. They said today it even went down more because of the hopes that things are going to settle down with the Ukraine and Russia war.
Right.
So there is that, and oil is actually quite a large number on the CPI report. So, but I do think that probably food and everything like that will continue to increase. So yeah.
Right. So I think it's super challenging to really, when you're thinking about sort of the overall markets. Obviously, oil is a primary input on the energy side, and so if you get energy prices lower, that I think lots of people think, okay, well, consequently later down the line, that actually turns into lower prices, for other things, but that will take some time. All right, so let's move on. Maybe electricity prices. I think that is, and we'll come back to part of this discussion. I think is AI. But any views on electricity prices? Do you think, lots of people, you hear oh, my utility bill is going up. Do you think AI is a real driver there? Do you think it's just that, like everything else, input prices have gone up, including electricity? Any specific views on this?
I think it's going to continue to increase because of data centers. They use so much electricity, it's insane. So it is driving the price up by quite a bit. So yeah. I think, of course, AI is going to continue growing. So, yeah. I think continue.
The marginal buyer is going to be these data centers, as you mentioned, or I think that's a big part of what's happening now. And so, if you're competing for electricity against them, typically not good. But overall, prices seem to be going up. I want to touch on the Nasdaq and the S&P, but before we get there, let's stick with some economic data. So. Lots of people are also super focused on the Treasury yield curve. Could you maybe talk about that? So we heard the numbers that come out today, and it sounded like, from the data that I got, again, this is 12/16, that the curve steepened a little bit. Any views on the 2s and the 10s right now?
So I mean, it's interesting because the 2 year is closely related to the federal policy, Fed policy expectations. So I mean, with the rate cut recently, it did go down. However, yeah, the 10-year, the problem with that is when you're looking in the long run. So you may be thinking, oh, inflation's going up, therefore the 10-year has actually gone up a little bit.
Right.
Yeah.
Yeah, and I think as you mentioned here, it's been stubbornly high. And so the 10-year, like 4.18 or 4.17, depending on where it is right now, as we talk about on this episode. But even with the Fed cutting rates, it's managed to keep the rate up. And I think, as you mentioned, a lot of that has to do with the deficits. It has to do with inflation expectations. Those things, the deficit remains a concern for many people, the amount of debt that the U.S. has, and also those inflation expectations. Obviously, those things are interrelated. But it's kept the 10-year around that 4.17, 4.18 right now, and it's been very difficult. So, and then maybe while we're here, maybe talk a little bit about housing. And so, housing is obviously a huge driver on the economy, and something that people think about. And certainly, the cheaper that you can get a 30-year mortgage, that probably brings more buyers into the market. And maybe it also increases turnover. How have you been thinking about the housing market from an economic standpoint?
Well, first off, I couldn't help but think of the 50-year mortgage that they were proposing, but hopefully...
what are your thoughts on the 50-year mortgage?
I mean, hopefully that's not a thing, because I feel like that's a large portion of someone's life to be in debt and just paying the mortgage, and that's it. No.
That's to give it to their kid, I guess.
Yeah, exactly. So it there is kind of slowing growth and slight declines due to high mortgage rates, and of course the Fed is lowering the interest rates. However, the 30-year fixed mortgage is remaining around 6.2 to 6.3%. And I think as long as, in the future, we'll see what happens. Yeah.
Well, let me ask a question on that. So it's at 6.3% now. Let's say, roughly, as you mentioned, for the 30-year fixed. If that goes down to, let's say, 5.5 or 5, even like something even more dramatic, do you think that that's going to get enough people that have a 4% mortgage, right? A lot of these, we hear a lot in the news that, okay, well, one of the reasons that you don't have a lot of increase in existing inventory for housing is because if you have a 4% mortgage or a 3.5% mortgage, you have to have a really compelling reason to move if you're getting a 6.3% mortgage. But if you get down to 5.5, do you think that inspires some people to move to say, well, maybe if I'm at 4, I know I'm going to pay more at 5.5, but I'm actually looking to trade up to a bigger house, or I actually want to live in a different neighborhood now. Do you think that that's actually going to increase inventory? And if so, what are the consequences for that?
Yeah, I think there will be more people putting their house on the market and looking to move whenever it does decrease more. So I think the only issue with that is that there will then be a lot of supply in the housing market at that time. And so for the short run, I think there will be kind of decreasing prices because they're, with a large supply and probably less demand. Because personally, I still think prices are too high for me to buy a house, but that's my personal opinion. But yeah.
No, but I think, look, that's an important point that maybe it's counterintuitive. Rates actually will come down and actually will have maybe, even if it's not lower prices, we'll have downward pressure on the prices. So maybe they don't increase. But, even with lower rates because of that. And so I think that's very disinflationary, actually. And so that would be, I think, a positive move for the overall economy if let's say that it is put a downward pressure on those prices, which have been tough. And I think you mentioned that the 50-year mortgage as an example. And one of the things has been that, okay, well, it's not affordable for first-time home buyers and for young people to get involved in these things. And so they're launching these new products. We're not endorsing any of these, just to be super clear. including a 50-year mortgage. But if there are ways to get people involved in the market and get people in the houses, I think that's the idea there. But how that gets executed, I think, is very challenging. As you mentioned, that's a large portion of someone's life to have that mortgage. All right, now maybe moving on. Let's go to the equity markets. So if you think about the run that the Nasdaq has had, the run that the S&P has had, and obviously for the investment institute, we think about this all the time because we're all of our portfolios are equity based right now. How do you think about the markets this year? So we've had certainly, we started off strong, and then you had Liberation Day, and then but since then you've kind of had a big run back. Where do you think we are now, and where do you think we're going into 2026?
I mean, overall, we've had great gains. The S&P and Nasdaq have grown quite a bit this year, and then also, just our portfolios, we've gone from like 10.3 million to 11.3 million in
right.
over a year.
It's been a good year.
Yeah, it's been a great year for us. But yeah, so we'll see what happens. I think it's going to continue to grow and keep going up, to be honest. And I know a lot of people are worried about the AI bubble.
Right.
Personally, I think a lot of the big drivers like Nvidia and ones like that aren't going to falter. However, I think, some of the smaller ones might end up, having trouble at one point. So, yeah.
Yeah, I think that's an important distinction. And as you mentioned, it's something at the Investment Institute we think about a lot, which is, look, Nvidia is our largest position at the moment and remains so. It's come under some pressure recently, but I would also agree that, look, there's going to be winners and losers in this race. And I think, Nvidia, is a winner, not investment advice, everybody. Educational entertainment purposes only. But I do think when you start to see how the markets pick these winners and losers, and as these companies perform, I shouldn't say the market's going to pick them, they're going to demonstrate their performance on fundamental side, and the market will follow. Any, specific parts of AI that are most exciting for you, or the things that you think about the most that will drive the market in 2026?
Well, I think with AI, it's interesting because, I don't know about you, but my job has become more efficient already.
Nice.
And so
mine too.
Yeah. ChatGPT is great at,
Which models do you use the most?
I use ChatGPT still the most,
okay.
Which I know I've heard Gemini has gotten very good these days.
I think Gemini 3 is very good. I think it's a massive upgrade from 2.5.
Okay. So yeah, I think it's just, kind of, they were the first to enter the market,
right.
And I'd been using it and haven't changed.
Yeah.
But yeah, so I think though, it'll be interesting to watch like employment and things like that, because like I said, my job's already become more efficient. So, we don't need to hire anyone else,
right.
You know what I mean? Because I'm actually being able to do quite a few things
right.
at once. So.
Well, it's like having an assistant now.
Yeah,
it's
exactly.
like all these things I need to do. It's like, well, actually I can kind of farm out some of these things. And maybe a follow-up question to that is, getting back to some of the economics and the way that people think about this is that, okay, well, people are talking about productivity gains from AI. And you mentioned it right there that, look, maybe people are not getting rid of people, but they're not maybe hiring at the same rate. And certainly the organization is saying, well, it's because of AI. What's your view there? Are these productivity gains coming through now? It sounds like for the investment institute, they are. Great news and agreed. But, for the broad market, do you think people are actually getting these productivity gains? And do you think that they'll accelerate into 2026?
I do. I think, we'll continue to accelerate for sure. I think, AI is just going to get bigger and better. So, yeah, exactly.
And on the productivity side, any specific areas that you're most optimistic? Do you think it's, it will continue to be like redundant tasks, or helping like put together basic, for example, presentations and things like that? Or do you think this agentic AI is going to be a bigger part of 2026, meaning that, whole, types of activities that you don't even really have to monitor day to day are going to be a bigger part of that?
I think kind of all of that. So
all of the above.
Yeah, exactly. Hopefully, it'll eventually be to where it can like help you do things before, like without having to input certain things.
Right.
It'll, learn.
So you can give it a bigger job
Yeah.
and say, look, these are the things that we need to get done over the next 6 months. You go out and figure out where you need to get the data from. You go out and figure, how it needs to be put together. This is the end product that I'm looking for. And it will do that without having to check in and ask each time, oh, do I need to take this data? Should I take that data? It does its own reasoning. It makes its own decisions. And again, really becomes more like having another team member that's super efficient. And I do think Gemini 3.0 is an important upgrade there.
Yeah, definitely.
All right, so we're closing in on the end of the episode here. And so 2026 is obviously right around the corner. Are there any other things? AI is obviously a big one. Are there other parts of the market that you're super excited about that you think as business people, investor, analysts that we should be paying attention to? Or are there specific things that we've already covered that as an analyst, business person, investor that you think the Hinman Economic Report we should be paying attention to?
Personally, I think still AI.
Okay.
It is interesting too. I saw like SpaceX is doing doing an IPO and things like that. But yeah, and then I am thinking about how like India is an emerging market that actually is probably going to surpass like Germany and Japan as the third largest economy, behind of course US and China. So
right.
Yeah.
Well, I think it's important to follow all those things. I'll say one thing on, you mentioned SpaceX, and I mentioned this on a few episodes, but I do think that it's important, and I think one of the reasons Musk at least was posting on X and talking about going public for SpaceX is that putting data centers in space. And so we've been talking about that on the podcast. I think initially people thought it might have been a little bit crazier than I normally am, but now you're hearing lots of people talking about this, and for all the reasons, because the energy demand that we talked about. So if you're competing for domestic electricity prices, it can be challenging just on the price side, but even getting things sited and getting things built. Well, you have, full-time solar. There's a giant fusion reactor in the sky. It's called the sun. If you put a satellite up, you don't have an atmosphere to be concerned with, and you have to radiate heat away, which we talked about on another episode. But, these things are solvable physics problems, and you put that data center in space, and it's, probably likely even accelerates AI even faster and further. And thanks for mentioning that. I do think I would add on, and we can finish out the episode on, that I do think paying attention to what SpaceX and data centers in space for 2026 is going to be super important for everybody to pay attention to. All right. Well, I want to say thank you to Kathleen Hinman, our chief economist and program associate at the GWII Investment Institute. Thank you for providing this first installment of the Hinman Economic Report. We'll hope you'll be back for the next installment. Thank you very much.
Thank you. Thank you for having me.
And that's a wrap for this episode of Market News with Rodney Lake. We'll see you back on the next episode. Thank you. Disclaimer, the content shared in the GWII Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GWII Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GWII Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.